Right, hopefully you can hear me now. So good morning, good afternoon, good evening, wherever you may be. This is just a quick program today, just to give you a bit of colour on today's inflation report, said to be the most important report of the week, really. And the first look at the latest set of cost price data from the US. We had an FOMC meeting last week, and so a little bit after the fact, but in terms of its importance, it's up there as a bellwether, really, and as a potential signal to where US interest rates will go. Right. Just to get some of the boring stuff out of the way first, just disclaimer: none of the information shared should be considered as financial investment or trading advice. The content provided on this channel is for informational and educational purposes only. Okay, so bear that in mind. No guests today. It's just me. As I said, it's a short, sharp look at what to expect. Just to give you a heads up for those who don't know who LiveSquawk are and new to what we do, we're a news aggregator, an audio news service, and we provide the financial market industry news and coverage of key data and events on a second by second basis. We start Sunday evening to cover the Asia session, and we work all the way through to Friday evening at the end of play US time. So for anyone who wants to see what we do or hear what we do, and to see if it will help your trading and investing, please go along to livesquawk.com and have a look at what we do. Right, there's that out the way. As I said, no guests today because I think this is so soon after the FOMC and everything else that we've had at the elections last week. Just a bit of overload, and as I said, this on its own is a trading opportunity, but builds into a picture where we've got another inflation report after today's one, alongside obviously the PCE, and another non-farm payroll report as well, or at least one before we get another FOMC decision in December. And again, coming so soon after last week's 25 basis point cut, people will be looking for signs that the message might change. So I want to give you I'll give you the rundown of what to expect, and then we'll have a look also at what some of the bank desks are saying. So in terms of the consensus for today's number, headline CPI year over year, which is the one I think most focus on, we're looking for a rise here of 0.2 to 2.6 for October from 2.4%. On the month, we're seeing also a rise of 0.2%, but that will keep it in line with last month's 0.2% gain. We look at the core reading, which is the ex-food and energy. On the year over year, we're looking at a 3.3% print. That's the expectation, and that would also be aligned with last month's level. And month over month, we're looking at a 0.3% rise, again, leaving it unchanged from previous. So we'll also see the index and core index release as well, which we pay less mind to, as well as real average hourly earnings for October, which came in at 1.4 year over year last month revised, and real average weekly earnings year over year came in at 1.1 revised from 0.9 previously. There is a report up on our website and on the social media platforms as well, just a preview of today's numbers. It's titled US CPI likely to provide Fed with greater confidence. US Fed Reserve then lowered borrowing costs for a second time in as many meetings last week, advancing its mission to normalise monetary policy. The decision came amidst the added complexity of a general election that will return former President Donald Trump to the White House. Recent price data has given the central bank space to cut. However, there is an argument that suggests that with inflation now on the rise, it may well be prudent for policymakers to pause in December and review activity. Again, we heard from the Fed Chair Powell at the presser last week that said labour and inflation data was in a more balanced space. And so, again, there's been a little bit of a row back on the likelihood of a rate cut at the December meeting. Nonetheless, I think the general consensus is that we will see a further 25 basis point cut, as we know that it's a lagged effect, and we're likely to see the effects of any kind of movement as it's 4 to 6 months behind. To give you some of the forecasters out there in terms of what some of the banks are expecting, As I said, consensus is for a 2.6% headline year over year. TD Securities are looking at 2.6, as are JP Morgan and Citigroup. And looking at some of the, I guess, the outliers there, you got Wells Fargo according 2.5, Barclays looking for a 2.5, Goldman Sachs think we'll see it at 2.4%, which would keep it aligned with last month, as do Bank of America. If the core CPI for October does turn out to be 3.4% or above, some say this would signify the first back-to-back, well, some would say it would be the first back-to-back increase in core inflation since September 2022. Some of the reasons for why we're looking at a potential strengthening in this core reading, really, again, we're down to services. We saw rental prices last month elevated. That was to blame in August, rather. But we saw a broader range of subsectors, including airfares, car rentals, and apparel, contribute to September's increase. And so SocGen Stephen Gallagher says positive that the inflation expectations may be the primary indicator to monitor in terms of how and when Fed officials might address potential inflation risks arising from Trump's economic policies. So looking past this data, some of these analysts are really looking towards the new administration, which with President-elect Trump's inauguration is on the 20th of January, and to look at what he does and the administration does to build growth and to accelerate activity across the US, and what that may then do to inflation expectations and the knock-on effect inflation itself down the line. Also, we do know that he's not overly happy with the current Fed chair, Jerome Powell, as he thinks he's held back really with monetary easing and could do more to help the US economy flourish. There's an argument for that, but also, again, as an independent central banker, Fed Chair Powell doesn't have to pay any mind to what the president says, as is the law. So we'll see how that argument plays out. Just for anyone's note, Powell finishes his term in 2026 and says he would not resign if asked to do so by the president. So there you have his side of the story there. I'm going to take a quick look then really at just some of the, as I said, what the banks are saying. We've looked briefly at what SocGen are looking for, just to see what else we have here. You got this is from Rabobank. They also talk about Trump and say today's release of the US CPI inflation report has been widely billed as the most important release of the week. It says optimistically on Trump, in the view of the inflationary connotations of Trump's fiscal and tariffs policy, a softer than expected report today would be a relief. It would imply that the US economy is entering a new Trump phase with muted pressures. Optimistically, this could prompt the conclusion that the Fed would have a free rein to continue cutting rates. An alternative view, however, is that the inflationary impact of Trump's policies will make the Fed cautious into next year, irrespective of today's release. A hotter than expected CPI inflation report today would clearly imply more limited scope for Fed rate cuts. Indeed, it is Rabobank's central view that the Fed's rate cutting cycle could be over in January on the back of the inflationary implications of Trump's tariff policy. Again, there is, as I said, after last week's meeting, we did see, and press conference, we did see a small paring back of some expectations for the number of rate cuts we'd like to see. From 175, I think, was generally the middle of the road, the median estimate in terms of amount of cuts we're priced into next year. I think I haven't looked at the latest set of data, but I think we're looking, that's probably the high end now, 175 basis points as the median forecast there. As I said, looking at some of the other banks here, you've got Danske Bank. Look at today's important release. In annual terms, they look for acceleration. Still accelerate due to base effects stemming from low reading a year ago. And this is the other thing for those unaware: base effects. So something happened a year ago, and basically the effects of that a year later have fallen out of the calculations, and therefore we could see a recalibration of price measurement a year later. So in that sense, again, they're saying the base effects stemming from a low reading a year ago could be, and their headline is for their forecast is for 2.5% from 2.4. So generally speaking, I think for the most part here, everyone's looking for a slightly elevated reading. No one's overly surprised if it does come in on the high side because of these base effects falling out of measurements. And so the risk is really if we start to see a lower than expected reading come through today. In terms of what it might do to some of the markets, CPI may keep dollar going. We've seen the dollar rally following last week's election. ING say the dollar rally is at risk of some positioning led correction, but we expect that US core CPI will come in at a relatively hot 0.3% on the month over month, which should keep markets rather hawkish on Fed pricing. They look for the dollar. They say second round of post-election Trump trades has now taken the dollar index to the 2022 highs as markets sink their teeth into the dual narrative of a wider rate and growth gap between the US and other developed countries. The latest news on the government appointment side is that Elon Musk and Vivek Ramaswamy will lead a Department of Government Efficiency, which aims to slash bureaucracy and spending. And says it's too early to tell what this it will effectively mean for public finances, but this confirms that Musk will play a key advisory role in Trump administration, which likely fuels expectations for deregulation and looser taxation. The stronger dollar is currently pricing in a good deal of Trump's policy mix, and the data releases, dovish Fed comments might offer some good opportunity to take profit in bullish dollar positions, is the advice of ING. Right, so as I said then, today's reading, I'll give you a quick look at, I'll go over again quickly what to expect for today. We're looking at a 0.2% month over month headline read, which will keep it aligned with last month. The year over year, we're looking for 2.6, a rise from 2.4%. As for the core measures, the month over month core seen at 0.3%, again unchanged from last month, with the year over year also core reading seen at 3.3% as well. So again, with that, we'll leave you to trade the number. If you're listening to this in real time, you've got just about an hour now before the release of the reading. Keep an eye on the subsectors, as I said. The core readings are important, and within that, the super core will pay close attention to as well. So keep an ear out for where that comes in as well, because I think that will be again within the report something to watch out for. And with that, I want to sign off and happy trading, and we'll have another session with a guest in the coming days.